You is for you, only you is for you. I'll never know, I'll never care, I'll never believe my people. I'll tell you what I say. I'll never lie, I'll never try, I'll never cry for you people. I'll push away as you lonely people keep on running round my door. Yes, you lonely people keep on begging back for more. And I cry for you as I die for you. Pain in my heart is real. And I tell you now how I feel inside. Feeling my heart is for you. It's for you. Only you. It's for you. I'll never try, I'll never die, I'll never push for you people. I'll tell you how I feel. I'll never lie, I'll never cry, I'll never try for you people. I'll tell you this is real. And you lonely people keep on passing time away. Yes, you lonely people keep on passing away. Yeah. And I cry for you as I die for you. Pain in my heart it is real. And I tell you now how I feel inside. Feeling my heart is for you. And I take everything as it comes my way. Pushing your pain round my door. And I cry for you as I die for you. This is blood on my hands are for you. You shiver and shudder, recovers your mother. You feel it, take control.
Hey, it's Soleil, and this is episode 296, I think, of the Orange Pill Investor. And today I want to talk about options expiring worthless. So I've repeated this a bunch of times, and I thought the number was like 90% of long options expire worthless, basically out of the money. And I looked it up just to make sure for this episode, and apparently there's some controversy about that. One site, the site that I actually used for my poor man's covered calls strike calculation, they actually said that that was a myth, and I think it was the CBOE supposedly reported that 10% of calls get exercised, and then they think that basically a leap was made from there, that must mean that all the other 90% expired worthless, but that's not necessarily the case, because some people just close out their options either for a profit or for some amount of loss. And then I think it was like they estimated 30% expired worthless. I did find another article though that claimed a study from was it Chicago Mercantile Exchange, CME data from like 97, 98, 99, which is pretty old data, but they claimed 70% expired worthless. Now, regardless of the number, well, maybe before I get to that, but that was kind of like, that's kind of like the basis for the option sellers kind of congratulating themselves, like, hey, we're putting all of this all these degen option buyers money in our pockets. And depending on who you believe, maybe that number is over exaggerated. But even if we believe the first one that I mentioned, 55 to 60% are closed, it still doesn't mean that they weren't closed for a loss. So just for an example, if I was making a directional bet on the 450s next week, my break even is actually 463 because it doesn't just have to get up to 450. It's got to go up to 450 plus the 1300 I paid for it. So I don't even really start making money until I get to 463, and then I start getting green. So if the price is 455, I could exercise it for 500 bucks, at expiration. But even if I do, I'm gonna, or if I close this out for $500 profit, I'm still down 800 bucks because I spent 1300 on this thing in the first place. But my whole point about even bringing up this topic was I woke up this morning and my mind must have been just racing all night and thinking about this shit because I thought, oh, well, the simple solution for not ever having an option expire worthless is just to never hold it till expiration. If you don't hold it until expiration, then it can't expire worthless on you. And I think that just kind of reinforces why, as a seller, I want to sell anything under 45 days to expiration, which is Tasty Trades research says that that's the optimal theta acceleration curve. And if that's the optimal theta acceleration curve as an option seller, then I want to avoid 45 days to 25-ish days to expiration at all costs, unless I have a damn good reason to do so. So really for me, I think, theta really starts to kind of pick up a little bit around 90 days, but not like terribly. But then when it gets to 60, it's amping up, and then at 45, it's really kicking into high gear. So let's just go and look at this and see if we can see how this plays out. So we've got, I'm not going to look at May because there's 2 months in here. But if I look at April's, and I'm just going to go up and look at the 500s. This is worth 110. Theta is basically 50 cents a day. And if the price doesn't change and we hold it for a month, the value is going to go from 510 to 99. What the hell did I just say? No, sorry. The strike I picked was 500. What the hell's the price? 110. 110 to 99. So we lost about 10% of our value in a month. But now theta has increased from 52 cents a day to 61 cents a day. So we didn't get hurt too badly here. The price is 99 and theta is 60. So when we go down from 110 days to 82, now we're just under 90 days to expiration. And now we lost 99 to 82. So that amped up quite a bit. So there's less value in the option overall, but we lost more of it. So it was 110. We lost $11. We lost 10%. Now we're gone from 99 to 82. So what is that, like 16? So basically 83. Let me round to 83. So that's $16. That's closer to 15%, maybe even more. And theta is 0.72. And then let's cut another month off. Now we're going to hit January. And this is getting really close to the 45 days to expiration. So let's see. The 500 strike goes from 82 to 58. Let's round it to 59. So 60 to 82 is $23 now we lost. So not only are we, not only are we losing more every month, but the total value of the option started at a smaller price. So we're losing vastly more and more percentages of our option. What, going from 82, so we dropped 23? Yeah, that was like, now we lost 25% of our value going from 82 days to 47 days. And let's do January 17th. We want this one, December 20th. The 500 strike is only worth 27. So that's cut in half now, right? We went from 58, half of that would be 29. So we lost over 50% of the value of this option in 30 days. So it went from 10% to 15% to like 25% to 50%. So that's why for me, I just start getting really nervous under 90 days. Now, do I have some? Yes. So I'm still trying to figure out how to use this damn web-based browser. But let me just take a look at my positions here. MicroStrategy. So for, I have this call debit spread for next week. I mean, I paid, I don't know, a couple $100 for it, but this is going to be a giant loser. And it was just a lottery scratch off. Like, this was never supposed to win, really, like, unless some amazing QQQ reaction happened based on the snapshot, which does not seem like it has happened yet. So this will probably be a loser. Very good demonstration of how short dated, long exposure, very often just does what it's supposed to do and loses money. I had my fingers crossed. I was hoping something cool would happen with it, but I might have been letting myself get a little too bullish and excited, making some short-term, uh, wishing upon a star or whatever. The next thing that I have is these Januaries, and as you can see, with these, I actually bought, I can't remember if it was like 10 of them, and then I sold half at double my profit. I'm gonna have to make this a little bit bigger, smaller. It's been open for 37 days. My trade price was 865, and they're not quite 10x anymore. I think when the price was 450, I could have sold these for 10x, but I sold half for double. And so that kind of just gives me the freedom to hold the rest all the way till expiration if I want to. And the worst I could do is break even. So even when I do take some, this wasn't even like short dated. It's got 47 left, and it's 37 days old. So what is that, 70, 84 days to expiration? I'm generally looking to sell at that point, but I was like, all right, let me just do this. I'm bullish, so let me just take a short-term flyer. And the reason is because the option prices react more strongly the shorter the days to expiration is. So I wanted to just see if I could expose myself to some serious gamma and see what would happen. And I did get lucky with these, but it's generally the opposite of what I would normally do. And taking a reasonably small flyer on this was kind of okay, I think. But as soon as I could, I locked in double the profits on half of the options. So the worst I could do is break even. So if we trade sideways until January, then these will have at least just not made or lost me any money. However, I did mention yesterday that I'm going to be taking off a bunch of leverage positions on Monday and or selling some covered calls, because at this point, I can weather a storm probably if MicroStrategy crashes 50%, unless I get a margin call. So really, this margin use is the only thing that can sink my battleship. So to have the one thing that could damage me the most be there when it doesn't make any sense to do so, like all I got to do is close enough positions to not have any margin, and it just takes a big risk out of the whole scenario. And the fact that I'm not going to have a real job anymore come next Friday, I really should not be dealing with some existential threats. So I'll probably have to at least keep one of these for sentimental purposes just to see if it goes in the money. But the other thing I might try to do is even see if I can figure out how many of these long calls I can sell covered calls against. Generally, I like to get to 0.7 delta before they qualify. And these are like, what, like 0.5 delta? So I'm going to need MicroStrategy to pump another $50 a share before maybe these qualify. But actually, let's just check it out. Let's just check this out. So the formula is the short strike minus the long strike plus the premium collected has to be greater than the value of the long strike. And so as a shortcut, the value of the long strike right here is about 70. And if I add 70 to 460, that gets me to 530. So can I find... Actually, 45 days to expiration is right when this one expires. So that would be basically just turning this into a call spread. If I try to sell covered calls against these, that's kind of interesting to think about. So way at the top of the chain, what did I say I needed to get to? 530? It's not very much. All right, so let me just see if I sold all the way at the top of the chain. The short strike minus the long strike would be about 600. Plus the premium is 15. That's 615. That's way the hell more than the value of this option. I don't know. Might be able to make it work. But yeah, so that's my plan. Monday, I will be reducing all my margin risk to 0. And I don't know if that's going to mean closing some of these long calls. These are about 5x in profit. These are about 3.5x in profit. And actually, if I roll these, let's see, these are worth 107 right now. If I roll the Aprils up to the highest strikes available, so I could keep the expiration date, but I can roll these up to the 1,000 strikes and keep not quite half of the profits. That might get rid of all my margin right there. All right, so the point is, theta becomes a greater and greater risk the closer we get to expiration. So all of this 47 days to expiration and under stuff, I'm not saying that they can't be profitable, but we're adding additional headwinds. There's extra hurdles that have to be overcome. So not financial advice. I'm not saying people can't make money in this range long. However, you have to realize that the deck is starting to become stacked against you, and you better be damn right on the direction, and it has to happen fast. the yeah. Anyway, I think that's everything I wanted to talk about. Let's check the chats, and we might call this a short one. What's up, Angry Buddha? It's the end step, not the journey of the paper. I'd really look into that write-up I sent you. It is specifically looking at options in this way. Yeah, I did read it, and I'm letting that rattle around in my head a little bit before I reply. I think I've already run into the main problem with selling options into MicroStrategy. Where's the chart? Here we go. So it's one thing to look at the numbers and say how many times something breaches your strike. But when the price was 1200 and I put like 20% call away value into my covered call option for the next week at like 1400 strike, and then the price went to 1700, I missed out on $300 of price appreciation. So you can say, okay, we're going to breach our strikes 10% of the time, but breach it by how much? $1, $5, $10? Or in this case, this was pre-split numbers, but it was like $300, which was when the price was 1200. That was like 40%. That was a 40% move, and I only captured 20% of it. And my IRA in particular has never recovered. So this is my IRA. I had at my IRA. Why isn't it? Oh, here we go. So prior to March, I had 100 shares in my IRA, which means after the split, I should have 1,000 shares in my IRA. But I had a similar covered call on at that time. Those shares got called away, and the best I could have done at that point was, let's see, like sold a put or something at the 1400 strike. Now, looking at the chart, if I had done that, maybe I would have been able to get back in as many as I might have been able to get back those 1,000 shares. But, oh, actually, no, because, yeah, I couldn't really afford shares again until the split happened. And then I was able to go back in and get some more. So I think it's a dangerous game. And I certainly wouldn't be mechanically selling covered calls against all of my positions. Maybe like a 60-40 split as a baseline. Like if you have 1,000 shares, 4 covered calls, and then if IV rank goes to 100 or more, maybe add on a couple of more. Being a little bit more strategic with it than what I was doing, which was just kind of like just plowing through mechanically, selling 20% out of the money every week, 20%, 20%, 20%, 20%. And then boom, we got a 40% move, and I missed out on half of it. So collecting, to miss out on a 20% move, collecting 1% a week, you'd have to be right 20 weeks in a row to make up for the move like that. And I just think it's very difficult. It's just tough sledding. So that's why I've been very hesitant to even put covered calls on recently. I probably should have just jumped in head first when IV rank got to over 100 and captured. I would have been selling covered calls in this area right here, but I only sold like one because I was too gun shy. I kind of got shook off my own strategy. But, I sold 1, 2, 3, 4, 5, like 6, 7 covered calls in this area right here. And every single one of them went underwater. And then I won this one single covered call that I placed here. I won that bet. So like 1 out of 8 covered calls actually went in my favor in this area here. And this is even being way more cautious than I was back here. I was just I was just week after week after week back here selling covered calls without any real fear. But this little March incident right here, I think showed me firsthand how selling covered calls and cash secured puts can get away from you if you just don't have thousands of shares to kind of just keep plugging along with. If all you got's 100 shares, you can get priced out of the stock, and you just basically have to sit around waiting for the next split to get back in. All right. Kanal says, I'm kind of interested now that you're dumping your job. What's your approach to health insurance? I'm probably just going to keep my same company. I've already checked the prices. I think it's going to be at least $1,000 a month for the family, just buying it straight up. It's not cheap, but I would, if I didn't have to worry about my son who's still in college and my wife, and she's found a couple of specialists that she likes and all of that good stuff, I'd probably just dump health insurance completely and do like a crowd health. And while we have our self-pay health insurance over the next year, I may sign up for crowd health just for myself only and see how I like it. And then, maybe pay out of pocket or whatnot. We'll see. George says, Sailor teasing new buys. Does that mean he's did he put something out that he's going to be buying more Bitcoin? Is that what's going on? Am I behind on the news? Angry Buddha, the author, is a retired tech guy. It was interesting the tools he was building for himself. Yeah, it did say technologist, so it made me wonder what kind of tech, because I'm a former medical laboratory technician before I moved over into IT. So I wonder if he's a medical technologist or is he something else? Kanal, if you ever got health questions, brother, let me know. I absolutely will. Thank you for that. All right, get your other questions in there. I might cover one more thing real quick while I'm in here. So sometimes people ask, like, what strikes, what days to expiration should I be targeting? And it seemed like he was a programmer. Okay, that's cool. So let's just say I'm going out to an expiration that I'm not terrified of. Like I'm over 180 days right here. I actually don't have any of these positions. But if I go all the way to the top of the chain, delta is 0.39 here. And on these, let me minimize this. For the ones that are like next week, it's probably going to be like 0.02 all the way up here. Yeah, let me just look at these because this is a better example. So these $1,000 strikes, delta is 0.01. And I thought of this when I was listening to Elon, I think it was on Rogan, and he was talking about how to think about your Tesla battery. And it probably applies to all batteries. But he gave the analogy that your Tesla battery is like trying to find parking. And, all the electrons, when there's hardly any cars parked, they can easily find space, right? When the battery's almost dead, it's easy to find space and it just charges really quick. And I think he said it takes just as long to charge the last 20% as it does the first 80%. But as the parking lot gets more and more crowded, then you're just driving around forever looking for a parking spot. And he said that was the same with the electrons. So once the battery starts getting crowded and starts getting full, then it's just harder for the charger to keep plowing more electrons into it and topping it off. So they've got a whole algorithm that, they'll charge you up to like 80%, and then you can just go about your way and then charge it up to 80%, 80%, 80%. And I thought, as soon as I heard that, I was like, holy shit, that's what options are. And this 0.01 delta on this damn thing, this battery is almost dead. However, if the price of MicroStrategy goes up quickly, it's easy to fill it up. So that's why when you get these price spikes, like, where's the damn chart again? You know, when you get these giant spikes, these practically dead batteries really go up in value quickly. But you scroll all the way to the in the monies, right? If you've got, let's just go to the 80% charged part. If you've got an in the money 0.8 delta, there's not much room left. So this starts acting less like leverage and more just like the stock itself. And then once you get to 0.99, like it can't even barely squeeze in any more value. So that's why I generally target, you know, on these MicroStrategy positions. Now, a lot of these things are in the money already, but I bought the top of the chain because, you know, a year from now, I fully expect MicroStrategy to be double, you know, triple what it is. So that made sense to me. But as we discussed, theta is also not only higher at short dated expirations, but it's also theta is higher at very far out of the money positions. So the value is going to drop out of, let's just go back to June. Yeah, so the 1080s, theta is 43, and you know, it gets lower and lower and lower the more in the money you get. So that's everything is a trade-off. There's no, I'm not saying that the top of the option chain is always the most desirable option. It does have the most room to grow, but it also, you know, kind of is basically decaying. Like that battery is going dead faster. So you have to have a sharp move quickly in order to justify that position, which is kind of another reason why these things that under 90 days are dangerous, because it's, you know, to forgive me for one more analogy, but it's like leaving the house with your phone battery on 2% and then hoping that you'll find somebody to help you charge it. Like, you're probably going to get screwed on that. But if you've got a year, you know, as long as you didn't pick a complete loser of a stock over a year, I mean, hopefully you'll be able to find some kind of pump. But the distance from this March, you know, to the time we got another pump was like 7 months. So if you're buying here and you picked anything under 7 months, like all of those options were worthless. Those were probably all losers. Does that mean buying long calls here are all going to be losers if they're under 6 months? I don't know. I I don't have any idea. Um, my basic assumption is that the number's going up for the next year, but I don't know. Are we going to get another 6 months, of sideways price action before we see it? I don't have the slightest idea, which probably brings me back to needing to put on some covered calls again. I really missed out on this spike big time. I'm kind of kicking myself for that. Probably a little bit of FOMO, like, oh, if we went to 500, it can go to 1,000, right? So I didn't want to short change myself, and I think I let a little bit of FOMO kind of shake me out of my strategy. All right, that's the last thing I got. We'll do one quick chat check, and then we are out of here. Kanal, by the way, love these 3 rules you posted recently. The most interesting one for me was by limiting unlimited upside, you protect your downside or something like that. Make a lot of sense philosophically and from a probabilistic point of view. Yeah, exactly. I think it's the reason why you would be willing to limit upside would be to increase your chances for success. Because every time you lower your cost basis, it just makes it that less likely that you will fail. And I think definitely for the beginning investor, that's probably the most important aspect because you're out there and you're like, I talked to some people and they're getting into investing and they're researching the companies and all this shit. And the guy was like, "Oh yeah, I think Walgreens is oversold and it's a good value." And I'm like, "Fucking Walgreens? Why would I even give half a shit about Walgreens?" Like they've got CVS and they've got all this competition. They're a brick and mortar store. And it's like, why are we even talking about this? But if I was determined to own some friggin' Walgreens and I could immediately sell a covered call against that position and lower my cost basis, and I could continue to do that, like even if Walgreens doesn't move, at least I can kind of like reduce my chances of failing, even if I choose a shitty stock. Um, and I used to be completely agnostic about the positions I sold. I would basically just go to Market Chameleon and I would sort the implied volatility for anything that was the most volatile. So give me anything that has just huge implied volatility. But this took a shitload of time. Like I know some people can build screeners and if I knew how to do that, I probably could have saved myself uncounted amount of hours. But I would just go to this ticker and then this ticker and then this ticker and then this ticker. Make sure that they had weeklies. Make sure that the implied volatility actually translated into premium because sometimes it doesn't. I mean, sometimes these things will be highly volatile, but the options premium still sucks ass. It's it's no guarantee. So I would spend hours just combing this thing just to find something decent. And then, so like I used to sell Nikola options on Nikola back in the day. Well, the founder got found guilty of fraud at some point. So there's definitely losers to be found. And there's, trading this long term, there was probably no way to trade this long term and make a profit. I mean, I guess you could have been short the damn thing the whole time. But this was just a whole lot of time. And I guess I learned a lot doing it, but it was a whole lot of time for not much reward. And then as a Bitcoin maxi, I basically just started settling on all of the Bitcoin derivative stocks. So I started running the mining companies. Tesla's not really a Bitcoin derivative, but they own Bitcoin, so they kind of get a free pass for at least having some on their treasury. But at one point, I basically just settled on Bitcoin and Tesla. And then when I found, MicroStrategy, that became basically my number one preferred stock, at least in this bull market. All right, Kevin says, "Do you want to know why this is?" I don't even remember what I was talking about when you posted this, but okay, so we're having a chat here. Canal says, "I get why, but it's something that's not immediately available if you're new to options. Must explain." Kevin says, "Must explain more in delta relative to second derivative gamma." All right, I'll let you give that a shot. I think I know where you're going with that, but maybe I don't. Okay, so I think we're all caught up on the chat. Appreciate everybody for tuning in and have a good rest of your Sunday. Be good, y'all.